Welcome to the Family Business Audiocast on LinkedIn. I am R. Adam Smith, creator of this audiocast series. As an entrepreneur, investor, founder, investment banker, and board leader the last 25 years, I'm fortunate for my many experiences within the family firm industry. A warm thank you to our live audience on LinkedIn today and for those listening in the future. A brief comment on why I created this broadcast. Private companies are a passion of mine, having grown up in a family of entrepreneurs and having engaged for 2 decades in deals, strategic transformations, investments, and boards with an array of fascinating family enterprises, family firms, and family offices. I founded this series to offer a useful platform for listeners to hear from veterans, academics, and leaders in the vast family firm ecosystem. Whether you're a family business owner, building, running, or advising a family office, or just expanding your family office activities, I hope these conversations are useful and enlightening. Now it's time to turn our attention to our accomplished guests on today's episode. Today, I'm very pleased to host my friend, Roger Vincent, founder and CIO of Summation Capital in New York. Roger, great to have you here today.
Thank you, Adam.
So today, we're going to cover a lot about your career and also the uniqueness of your product and how it relates to the family office market and investors and your partners and peers. Just the evolution of the alternatives market in general. I'll talk about you briefly first here. So Roger has over 25 years of experience across global private equity markets, and he is a seasoned investor and advisor and institutional allocator. He is the founder and CIO of Summation Capital, and there Roger draws upon his decade-long tenure, recently leading Cornell University's endowment private equity portfolio that was around $10 billion. And there he built lasting partnerships with, of course, top-tier and emerging manager general partners alike. And also his experience does cover the whole alt spectrum, buyouts, growth equity, and venture capital. He has a particular emphasis on alignment, value creation, and creating long-term partnerships with his clients. And his approach blends the rigor of the institutional investing lens, but also the spirit of entrepreneurship and offering mission-driven organizations and family office access to high-quality private equity solutions with transparency, efficiency, and purpose. I love that last line of transparency, efficiency, and purpose. That's great, Roger. It's great to have you here today. You ready to dig in?
Great, thanks, Adam. It's wonderful to be with you.
Okay, good. Thank you. We're glad you made it happen and to have you on the podcast finally. Cornell, you introduced a spirit of partnership, thinking about your relationships with the general partners as part of your formal evaluation criterion. That's a little bit atypical as a metric, as a KPI. So we'd like to talk about that first. On the podcast, we talk often about values, integrity, legacy, culture, and it's great to see the success of Cornell as a university and also your approach to building that platform and the legacy you left there. So maybe talk a bit about how that was for you and how family offices can apply that mindset in selecting investment partners themselves.
Yeah, the backstory here is I joined the Cornell Endowment to restructure and run the private equity portfolio in 2012. At that time, a lot of the large private equity firms were going public, and it was being said around the industry that the initial phase of the private equity industry was now transitioning to this more institutional phase. And I felt like partnership and that historic relationship that was very deep between GPs and LPs was still very much a part of the industry and a part of being successful in the industry. And so as we designed our underwriting framework, I came up with this concept, which we called spirit of partnership. And it was one of the key metrics on which we measured GPs and evaluated them for inclusion in our portfolio. And I think what it is trying to do is recognize that there's a lot of alignment in this relationship, a lot of desired alignment that isn't captured numerically or in the LPA. And because these relationships are going to go on for so long, we often think of them as like entering a marriage. You really want to make sure that you're getting something that you're going to be happy with over long periods of time in a variety of different environments and circumstances that you may not be able to predict at the entry point. And so getting to know somebody at a very deep level and feeling like you're very aligned with them in terms of philosophical views on the world, how you want to treat yourself and other people, these are the types of things that can make sure that you're going to be in a relationship that stands the test of time. And we just called that the spirit of partnership. But it's really just a holistic way of thinking about alignment. We've had examples where GPs have come to us and said, hey, we just want to reduce our management fee. We don't need the extra income. We think it might be hurting our returns, and we're really all about maximizing return, which is, of course, is very aligned with how we're thinking about things. That's the type of thing that you just can't get papered into an LPA. You're only going to get it if you're partnering with people that are really thinking about life the same way that you're thinking about it.
Right. I like that spirit of partnership. That's great. And you continue to build that into Summation today. So maybe just quickly tell us about Summation, and then I'll ask you a couple questions about it.
Yeah, Summation is a new type of investment vehicle, and what we're trying to do is replicate the experience that a CIO of a large endowment would receive by virtue of having a large, sophisticated team focused on building a private equity portfolio, a portfolio of exposures to private equity. And we wanted to bring that same type of resource and exposure to third parties who may not be at the scale of a large Ivy endowment, but still want that type of return stream. Perhaps the most important characteristic that distinguishes us from things that are already in the market is our compensation structure. We have a management fee and a carry like you might find in a fund of funds, but we keep the management fee really as low as possible, and we only take carry on our alpha over a benchmark. And that is a really important point. The endowments pay their staff by measuring them against an asset class benchmark, and they pay them for outperformance. And it really helps align focus of the team on what the endowment wants, which is to outperform their alternative use of that capital. I didn't see anybody doing this in the market. I felt like it was critical to keeping expenses low and also getting that incentives aligned. And I wanted to bring that same concept, which is prevalent throughout the endowment world, into the market.
So we talked about this when you and I were sitting on a sunny day at the Greenwich Economic Forum, right?
We did.
And
I'm glad you remember that.
Yeah, you were sort of in the second inning, and I seemed like you're kind of running quickly into the third inning. But I think as an entrepreneur, what you're saying is you want to create a long-term platform, and you're sort of like chipping in your value, your commitment, your sacrifice into the platform in a way that might involve some initial commercial sacrifice or personal capital and patience. Like, just maybe talk about that approach as an entrepreneur. And of course, you made the decision to start a new GP platform, which takes a lot of courage. But I think that as we talked about at GEF, you wanted to, let's say, lower the selection bias and have your skin in the game with your clients as limited partners. So maybe you just want to talk about that, and we can flip over, talk about the general partner side later.
Yeah, over the couple of years that I was developing this concept before I launched it early in 2024, I really went from, hey, this is a smart idea, to this is something that I really feel passionate about, and I didn't feel like I could live my best life if I didn't go out and make this a reality. As I considered this idea of alpha being the right way to align incentives on performance compensation, I think I got a little bit under my skin that everybody in the endowment world that I knew, the team at Cornell, my peers at the other similar organizations, were all signing up to this very high bar of performance, and nobody out there in the rest of the world was putting themselves up against that same metric. And maybe back in the 1980s, when the cost of equity beta cost something, it was appropriate to be compensated in part on achieving equity beta. But over the ensuing 40 odd years, we all know the cost of equity beta has fallen to essentially zero. And I think it's inappropriate that people that are doing allocation services would continue to get compensated for producing and riding equity beta. So that really compelled me to leave a seat like I had at a large endowment. Really takes a lot of initiative. First off, as you alluded to, it's not for the faint of heart to start a new GP. Certainly not in what I call a fundraising recession, like we've been in for the last couple of years. But you really have to want to do it for very deep reasons. I think reasons that are far deeper than just that you'd like to be your own boss. In fact, for me, that really was a very secondary or tertiary condition. But to get something like this going, you've got to bring a lot of dedication from a lot of different people to the table. I think that it's easier to do that. It may only be possible to do that if you really have a strong belief that what you're doing matters, that it's important that it become available to people. I noted that the endowments have essentially maxed out their exposure to private equity. Most of the large endowments have something plus or minus 30% allocation to private equity. If they could go higher, they would, but they really can't. So this asset class, which is so important to this group that they couldn't come close to achieving their return objectives without it, to me was still very hard to access for all sorts of other asset owners, be they family offices or smaller foundations or endowments. And so to me, what I wanted to do was be able to provide a way for others to access that same high quality, high return that we generated, and I think my peers are generating or trying to generate at the other endowments. We wanted to make that available in a very simple to use, low cost, and aligned form to other investors. So it really did become a bit of a passion project.
That's wonderful, Roger. Thank you so much for those references, and kudos to your initiative. I think also in the emerging manager world, because it's so challenging, it's important to have these conversations, right, and give motivation and courage to others like you. It's a tricky business model, but it's for the long haul. It does require the passion and courage, but it also requires some capital and some skin in the game. When I started my own management firm in 2002, I remember I think I financed it with $875,000. I would say that it's probably a little bit more these days, right?
Yeah, it costs a little bit more than that. It is a lot more cost effective to run the type of strategy that we are running. One of the observations I had from my time at Cornell was we were able to produce what have been called world-class returns with a very small team. It was really, for most of the time I was there, it was myself and a group of analysts who had just graduated from college, and they typically rotated between asset classes every couple of years. So you can generate good returns without a lot of resources if those resources are well focused, know what they're doing, aren't distracted by other things. We, of course, had to capitalize our management company. We wanted to be what we called institutional day one. And so we had to come up with some capital to make sure that we had sufficient resources to qualify for institutional capital right out of the gate.
Can you talk about that strategic capital into the management firm, as I did and other friends have, just for others to think about that? Just kind of run through like how you prepared for that and what that looks like and why that's important.
Yeah, so we think about building two investment streams. One is the portfolio, which we're targeting a 20% or higher annualized return on, and of course, that's the core of our product. but we're also building a management company, which has to be successful over a very long time horizon to support the operations of the fund. And it costs a couple of $1 million at the low end to run a good management company these days. There's a lot of regulatory oversight. There's a lot of reporting that goes into it, especially with a more complex structure like ours. I think that a lot of GPs make a mistake and they think that their ownership of the management company is something that they need to hoard. I took a different approach, and I think a lot of this was informed by my exposure over my career, but particularly at Cornell, to some of the world's best entrepreneurs in the private equity industry. And so I saw a lot of different ways of thinking about how to manage a management company. And I wasn't too concerned about being the sole owner of the management company. I wanted to share it with my team. I wanted people to realize that this was the type of place that they could build careers and real economic value. Especially in this type of work, having continuity for very long periods of time is critical to generating great returns. The endowments are able to retain people for pretty long periods of time, but even their turnover is a little bit higher than you might want it to be. I wanted Summation to be a forever place. And so I was, very eager to make sure that all of the partners and all of the participants in the Summation Management Company were really full participants. And other people as well, as you alluded to, the strategic partners who helped us get this off the ground. We wanted them to be aligned with us and to be a part of the management company.
Wonderful. So taking that entrepreneurial mindset to be a bit more generous, that obviously comes out of your pocket as the founder, but the ROI on that is high, and that gets people excited, and they kind of drink the Kool-Aid, they dig in, they're thinking longer term. Usually that's an LLC, and you create a vesting program, over the course of many years. So that's exciting, and it is an interesting position that you've been in, and elite investors like yourself, the institutional side and the fund of funds and the LP side. When you see hundreds of funds and those teams, you get to learn a lot. I think this could be a good time, maybe to share like one or two um, most most impactful learnings over the years, looking at the landscape of the industry. Like what are some things that come to mind?
Yeah, this is one of the tricks that I offer to people when they're asking questions about how to underwrite GPs. But it just has a lot of good lessons encompassed in it. And the short way of saying it is I like to invest with people who think as deeply about their own business as they think about other people's businesses. If you go back 20 plus years in this industry, it was a lot less common. You would have the managing partners, the senior partners of private equity firms that would spend a tremendous amount of time thinking about the business model and the businesses that they were investing in. And they would spend relatively little time thinking about their own business. And that led to a lot of trouble with things like generational transitions, where they really hadn't prepared years ahead of time for what that might look like. It was still very much a boutique business that they didn't consider these types of thoughts on. And so, a really great way to find a shortcut to find good GPs is to find people that are thinking as deeply about running their own business as what they're investing in.
I like that analogy. Um, let's come back to the Summation name and like what that means and how it relates to bringing together human capital, bringing together intellectual capital, ideas,
Yeah.
and the collaboration mindset internally within a general partnership.
So there's a couple of meanings to the name, but the primary one is I wanted this to be a vehicle that encompassed all of what I call the hard things about investing in private equity. When people think about allocating to private equity, they spend a lot of time thinking about manager selection. And even within the institutional allocator world, I would say the vast majority of discussions are about that. They're about manager selection. But truth be told, there's 4 or 5 other things that are arguably of equal importance to manager selection. And those things are very challenging for people to do and to do well. And I thought if I was going to produce a really turnkey solution to other asset owners, I was going to have to solve for those as well. So I'll run through what I think are maybe the most important ones. The first, which is the least interesting, is just operations. You can't do any of this without really strong operations. A well diversified private equity portfolio, and this may shock a lot of people, is going to have something like 200 or 300 funds within it. Fewer managers, but multiple funds within managers. That's an amount of operational complexity that the vast majority of people who would like to have exposure to private equity are not going to be able to handle. So, being able to provide operational complexity and turn it into simplicity is really important. Investors in Summation get a single K1, but they get the benefit of hundreds of underlying positions and the diversification that comes with that. Another important concept is vintage diversification. This is probably the most important principle that you'll find across the institutional allocator world in private equity. It's hard even for a well-run institution like an endowment to get this right. In this latest downturn, you really saw a separation between those institutions that had prepared and were able to maintain good vintage diversification, and those that were not, which is oftentimes just called the denominator effect. They got badly caught by the denominator effect. So I wanted to create a solution that provided vintage diversification, even for asset owners that might not be able to do that themselves. And then the last one I'll mention, and this usually doesn't get thought about till you're years into building a private equity portfolio, is unfunded liability management. And it's a little bit esoteric, but as anybody who considers investing in a drawdown fund should know, as soon as you sign those commitment papers, you've created a liability for yourself. And managing that liability is very important to your holistic return and the success of your private equity portfolio. So the name Summation is meant to evoke this concept that we are going to wrap all of those hard problems into the fund structure and solve them there with a dedicated and focused team, and not leave the asset owner with so much of a burden that they usually have to handle for themselves when they want to access this asset class.
That's very thoughtful, and it probably is directly correlated to the importance of having strategic partners and investors and working capital in the holdco, at least initially, if not over time, right? In terms of a liquid firm, I would imagine that's relevant. And then also, like looking at the lessons we've learned over market cycles and the impact of J curve, like you're saying, on funded liabilities, we've seen the J curve back up the last couple of years, and that is precarious. Maybe just talk a little bit about the J curve, and then kind of lead us into the benefit of continuation funds in the secondary market to offset the J curve risk.
Yeah, so I love the old saying, or the I think it's maybe a Chinese proverb, which is, the best time to plant a tree was yesterday, but the second best time to plant a tree is today. There's typically a lot of incentives against starting a private equity program, and the J curve is the primary one of those. You may not get returns that show up in your financials for a couple of years. If you have somebody running your portfolio as a CIO or an asset class head, they may not be incentivized to do something that's not going to produce returns in their time horizon or what they see as their time horizon. So there's no really foolproof way to get around this. I think you really have to be dedicated to wanting to generate long-term returns. I'm talking generational, if or multi-decade returns and be willing to have that long time horizon and incentivize your team appropriately to generate those returns. That said, there's a very high prevalence of views that you can mitigate or get around the J curve through secondary funds or some other tactics. I tend to be a little bit of a skeptic on that. We have not invested in secondary funds. We didn't do it at Cornell. I don't anticipate doing it at Summation, but there are some other tricks of the trade. They tend to be variations of that. And the one that we're using today, which has been very effective for us, is what we call baked or seasoned primaries. So there are a lot of funds out there that have been investing for some period of time, but they haven't closed their fundraising. You can see some of the portfolio that's going to exist. So it's not a complete blind pool, but more importantly, it's already started to mature. So we have, even though we only started committing capital in 2024, we have underlying exposures that go all the way back to 2022. And the denominator effect was in full force then. It probably will be a very good vintage year. So to get some of those exposures in our portfolio, I think is a really positive way to launch.
Good. That's great. Let's go back to the family office market. We know it's quite expansive now, and on the podcast, we've talked to some of the elite leaders in the entire world on this, and meanwhile, it continues to grow. 5 trillion or more. Lots of liquidity. Of course, some of the liquidity is not really apparent with the J curve backed up after COVID and inflation, so that's kind of ironic. But I think it will start to loosen up a bit if our economy is at least in a soft landing. I would like your thoughts on the next year or two on liquidity, and then just talk about the scalability of your platform. Like, where do you want to go the next couple of years?
Well, liquidity has been a big topic of conversation in the industry. As I said, even some of the endowments struggled maintaining appropriate liquidity in their illiquid assets. One of the benefits of the endowment approach with this very high level of diversification is not just what it does to both returns, which it enhances, and risk, which it mitigates, but it also significantly improves the cash flow characteristics of the portfolio. So this will surprise a number of people, but what I will tell you is a well-diversified, meaning across vintage years, across segments of the market, a well-diversified private equity portfolio probably wouldn't go cash flow negative even in 22, 23, 24. So people that are feeling like they don't have as much capital coming back from their GPs as they're having called, that may be a sign that they didn't have a well-diversified portfolio. And so I can speak to specific examples of that not having to be the case. For people who are considering committing to private equity, traditionally low fundraising years are very good performing vintages for exactly the reasons that'll be obvious. So we're very excited about being able to deploy dry powder into the past couple of vintage years and the vintage year that we're in. It's anybody's guess when distributions will really start to come back, when the IPO market will open, when private equity firms will feel pressure to sell long in the tooth holdings and generate liquidity for their LPs, even if it's not at the performance level that people want. Obviously, we're closer to that day than we were 6 months ago, but it's really hard to predict whether it's this year or the latter half of this year or this year into next year.
That makes sense. One more topic on the investment process and structure. Let's talk about alpha, and especially from a family office perspective, when they think about their asset allocation, their efficient frontier, and they want to create alpha. What do you think are some of the best practices for a larger family office to look at alpha, and what does that alpha mean in today's market? And in the sense that alpha is more alpha is great, but then there's also the issue of let's say the like you said the liquidity longevity, the spectrum of that alpha. So it's not just about pursuing alpha; it's also how that fits into your balance sheet and your cash flow management.
Yeah, so in private equity, or really any asset class, the way we're thinking about alpha is what is the performance relative to an easily accessible passive exposure that has, a similar risk level. So for private equity, the benchmark measure would be a broad liquid equity index. If you can't outperform that, then the asset owner really could have had better returns and full liquidity without this sojourn into private equity. So we view that as an appropriate level of measuring value add or alpha. For other asset classes, it would be an equivalent liquid, easily accessible, beta measure of that asset class. We we think that the evidence is pretty established that there's more alpha to be had in private equity than there are in other asset classes. At the median level, private equity outperforms liquid equity by about 300 basis points. That's a lot more than you'll find in other illiquid alternatives like credit or real estate. So if you're trying to maximize alpha, even without good selection, if you can just achieve the median, you're going to get your most outperformance in private equity. But then on top of that, there's also the greatest dispersion of returns. And so if you can get up into the first quartile of private equity, you capture both the illiquidity premium of the asset class, but you also capture a lot of manager selection alpha. And we're talking many hundreds of basis points of potential outperformance there. So there are a lot of great funds in other illiquid asset classes like real estate, credit. If you have a unique perspective that allows you to underwrite well there, then that's a reasonable place to spend time and effort. But if you're approaching all of these alternatives in the same way, you're going to get more bang for your buck by doing dedicated, good work, manager selecting in private equity because of that dispersion of returns.
That's great. I have just one more topic, and then we'll wrap up. And thinking about your long-term legacy, I do want to come back to the human capital element. Having looked at hundreds and hundreds of funds, we know that the quality of the general partner, especially the key partner on the fund, is key. But if you could just share some of your learnings on human capital front and culture, especially, let's say, if you're a family office looking at investing in a fund, or with you, like what are some of the thoughts that come to your mind of like how to observe and analyze the human capital and culture of a private equity firm?
Yeah, so maybe stepping back a little bit, most of our clients are family offices, and so we really try and take a partnership approach with them. We want to be thought of as an extension of staff almost, and to work in conjunction with the internal team. Having been in this industry for now almost 30 years, about half of which was doing direct deals and half of which is been an allocator, I think I can speak with a fair amount of authority in terms of what type of resources it takes to do each. And one of the things I see a lot of families doing is under resourcing their teams and having them do not just direct deals and co-investments, but also fund investing and usually not just in private equity, but in other alternative asset classes, managing other parts of the portfolio or doing other things for the family. And I think that people might be underestimating just how much time and effort it takes to do a direct deal and how much time and effort it takes to do build a private equity portfolio. These are not things that are easily done at the same time by the same team without a very large amount of resources. So what I advocate people to do is to take their internal team and focus them on those direct deals, those co-investments. They usually have some tight nexus to the mission or the perspective of the family. and then outsource if you can do it in a smart, high quality way with alignment and low fees, which is what we do. Outsource that very broad diversification. I have a saying which is you can you can feed yourself by hunting and you can feed yourself by farming, but if you try and do both at the same time, you may starve to death because you won't do either one of them well.
I like that analogy of the focus. All right, last item. What's your favorite part of your job? Like, what gets you fired up in the morning from building Summation? And then we'll wrap it up.
Yeah, well, I'll bring it all the way back to the spirit of partnership. One of the great things about investing in private equity is you're really investing in people and you're building deep relationships. This is not just with your GPs, but with those people that you're a capital partner to, those people that are on your team. It really, you get to work with some of the best people in the world and see them at their best. And I love the that human component to what we're doing.
Awesome. I'm very proud of you, and it's exciting to see this. I think Summation can really scale, and I encourage our listeners to reach out to Roger on LinkedIn. And finally got you on the show. This is great. Going back to our chat at the Cornell Technology Forum. I'm just happy to have you here today.
Thanks, Adam. It's been wonderful talking to you about this and having you watch us as we've been able to take a vision and turn it into reality.
Very exciting. Great to have you here today. This is Arden Smith signing off. Please stay tuned for the next episode of the Family Business Audiocast, available live on LinkedIn, YouTube, and X.